Let's talk about the starting point for most home loans, and that's your credit score. I explain it this way. Your credit score opens the door to loan programs, and then each loan program will have its own guidelines that need to be followed. But the starting point is that credit score. You see, for decades, information about how consumers use and repay debt has been gathered and analyzed by the credit industry. Millions of data points have been studied to identify patterns and behaviors that may indicate how likely someone is going to be repay a future loan obligation. And the result is that credit score, a 3-digit number that serves as a snapshot of your credit risk and helps lenders assess how you've managed credit in the past. Now, when applying for a mortgage, we pull credit reports from the 3 major credit bureaus, Experian, Equifax, and TransUnion. And because each bureau may report slightly different information, it's common to receive 3 different scores. For mortgage lending, we're generally required to use the middle score. But it's also important to understand that there are different scoring models and algorithms depending on the type of financing you're seeking. For example, a credit card application may use one scoring model while an auto lender may use another. Today, the mortgage industry uses FICO scores. The Advantage score model is beginning to move into the mortgage space. However, it's not been widely adopted by the mortgage industry. Why? Mortgage lending uses one of the most strictest credit scoring models available. Because your credit profile is dynamic, it's completely normal to see some variation in your scores from one source to another, and even from one point in time to another. That's why the score you see on platforms like Credit Karma or even through your credit card company may be different from the score your loan officer receives when your credit is pulled for a mortgage application. Not all factors are weighed equally. Payment history and the amount you owe represent the lion's share of your credit score. Together, they account for about 65% of your FICO score. Other factors do influence your score, but historically, they've not been as powerful as those first 2 categories. One of the best examples is credit card utilization, or how much of your available credit you're using. Let me give you an example. Let's say you got a $1,000 credit limit. If you owe about $900, you're still within your credit limit, correct? However, the scoring models view that as being 90% obligated on that account. The scoring model may view your credit profile as presenting a higher level of risk, and historically, points have generally been taken away. Now, let's say your balance is about $500. You're about 50% obligated. Historically, I haven't seen this level result in points being taken away, but I typically haven't seen points added either. It tends to fall somewhere in the middle. Now, here's the powerful piece. Let's say you only owe $250 on that same $1,000 credit limit. Now you're just about 25% obligated. In the hundreds of action plans that I've created over the years for my clients, I've consistently seen lower balances produce stronger scoring results. Historically, the algorithms appear to favor consumers who use credit as a convenience and maintain lower balances relative to their available credit limits. Is there a guarantee that scoring models will always behave this way? No. Credit scoring models can evolve and change over time. However, this pattern has remained remarkably consistent throughout my nearly 4 decades of helping clients understand how to improve their credit profiles. So my words of wisdom is this: keep your credit card payments below 25% utilization, make your payments on time so you have no late payments, and your credit score should change to the positive if it's not already there. If you're wondering how this all applies to your own situation, that's exactly why I created the Buyer Ready service. The Buyer Ready service is designed to help you better understand where you stand today. identify opportunities for improvement, and create an individualized action plan based upon your specific financial profile. For some people, that might mean they're ready to move forward now. And for others, it may mean taking a few strategic steps first. Either way, my goal is to provide education, guidance, and a plan so you can make informed decisions and move forward with confidence when you're ready. As I create new Home Ownership Matters educational webinars, I share them with my followers so they can continue learning about credit, mortgage readiness, and the home buying process. You can follow me on social media by searching for Home Loans by Karen Jones. My Facebook page should appear. And you know what? I also regularly share educational information and resources on my Facebook page as well. So I invite you to follow me. So let's clear up some common myths that are out there in the marketplace. The first myth is that carrying a balance in your credit card helps your credit score, and it doesn't. In reality, carrying a balance on your credit card simply costs you money because you're paying interest. You don't have to pay interest to have a good credit score. In fact, using credit and paying off your cards in full each month can be an excellent way to demonstrate responsible credit management. Another myth is that paying off your credit card and then closing down the account will automatically boost your score. In many cases, closing a credit card account can actually lower your score as the average age of credit and the change of your overall utilization ratio changes. A third myth is that checking your own credit hurts your score, and it doesn't. Checking your own credit is considered a soft inquiry and generally does not affect your credit score. And finally, one of the biggest mistakes you can make when buying a home is making large purchases right before closing. I always tell my clients to contact me first before having their credit ran or even using their money to buy large purchases. A new credit inquiry will need to be reviewed and approved by underwriting. And if that new debt changes your qualifying, you can lose your home. A credit refresh is completed at the final stages of your home purchase. And your employment is also verified. The key takeaway is this: verification occurs throughout the lending journey, and credit scores are built through responsible and consistent credit management over time. One of the biggest misconceptions I see